Good morning, everyone, and thank you for joining the Pennant International Group PLC results presentation. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab, which is located on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the presentation. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that today's presentation is being recorded. I would now like to hand you over to Philip Walker, Chief Executive, and Darren Wiggins, Chief Financial Officer. Gentlemen.
Thank you, Tom. Good morning, everyone. My name is Phil Walker. I'm the Chief Executive of Pennant International Group PLC. This is our first annual results briefing using IMC following the launch and reintroduction of Pennant to the market in December 24. I'd like to welcome any existing shareholders, investors to this meeting, as well as any potential new investors. I hope you find this informative and useful. During this session, I'm joined by Darren. Darren's our new CFO. He's been with us 6 months. Thank you.
Yeah, good morning, everybody. Pleasure to be here today. As Phil says, I joined the company on an interim basis in September of last year, and I was very pleased to make that position permanent in November 2024.
So today's presentation is designed to be a summary of the new Pennant, reinforce the message and the position we presented in December, explain how the business is changing, provide a detailed overview of the 24 performance, which Darren will walk you through, and talk a little bit about the opportunities and the outlook. We do look forward to your questions, but also your feedback after the session. So without further ado, let's get into the overview of the period. So Pennant is now 67 years old, but the key takeaway from today, for those of you who know Pennant or new to the story, is that the business in front of you here today is not the same business it was 12, 18 months ago. 2024 has been a truly transformational year for the business, and decisive action has been taken by the business to pivot towards a highly scalable software and services model. As we go through this presentation, hopefully we can bring out some of the rationale for those changes, and Darren will walk you through the streamlining of the training business from a financial perspective and also from a commercial rationale. Pennant is on a journey. We've achieved some hard yards in the last 6 months, and we've still got work to do, but we're set up for growth, and I hope you'll find that this presentation will give you a degree of confidence that Pennant's moving in the right direction. So let's move into the main presentation, Tom. So what is Pennant? What is Pennant about? Everything we do at Pennant is designed around what we call maximising operational efficiency. What does that actually mean? What is the problem statement that we're trying to help our customers address? The key question is, how do you deliver operational effectiveness at optimal cost? We have a saying, we want to make sure mission critical assets are available when they're needed, where they're needed, and most importantly, that they work. Never that been more relevant in the current climate. That's the global backdrop, the uncertainty in the world, events in Eastern Europe. And our tool set and our capability allows our customers to make data-driven decisions around optimization and their support solutions. And critically, our software complies with all the governance and standards and specifications you'd expect in these highly regulated and safety-critical market. Later through the presentation, I'll give you examples of the tools in action. But our aspiration as a business is to be the system support enterprise solution of choice. And everything we do today is geared around scaling this business to deliver growth globally of our software tool set. Next slide, please, Tom. Thank you. No, sorry, customers, please, Tom. So Pennant, particularly proud of this slide. We do have a truly global customer base. You can see from the names on the presentation there. Very proud of our heritage, very proud of our relationships. The challenge for Pennant is to move up the value chain. The launch of the Xilium suite, which I'll talk about in more detail shortly, is enabling us to offer our customers a much broader end-to-end service. And we've been changing our go-to-market model to actually move away from our traditional direct selling into an indirect model. We've been working hard to develop those partner channels to enable us to access new markets, new territories, and then cross-sell our capability into our customer base. And you'll hear a lot about that as we go through the presentation later. But how do we operate? Darren, I'll let you cover this one.
Great, thanks, Phil. As we presented in our last IMC presentation in December, we addressed the market through three key segments. First of all, our system support software segment. Secondly, technical services. And thirdly, training systems, the heritage part of the Pennant business. In terms of system support software and technical services, we see these as characterized by recurring, repeatable, and predictable revenue. Our system support software is proprietary software applications developed or acquired by Pennant over the years. Software tools that Phil will go into a little bit more detail on shortly, again, consistent with the presentation we gave in December. Technical services is the largest segment of our business. When we look at 2024 numbers, makes up around 50% of our business. It's characterized by a global team of experts providing consultancy, maintenance, training, bespoke development services to a global list of customers across multiple industries. Last but not least, the training systems business, as Phil alluded to, subject to quite a significant restructuring exercise in 2024, which we'll come on to more detail later in the presentation. Project-based revenues, as we say, 67 years of heritage of putting some highly engineered, sophisticated applications into the field, largely in the UK and the Middle East. We'll come on to give more details about the restructuring later in this presentation. Okay, Phil.
Thanks, Darren. So what is Auxilium? So Auxilium is the name that we've given to our application suite of software. Auxilium, as I mentioned last time, is the Latin name. That means to support and assist, and everything we do at Pennant is about supporting and assisting our customers. Whilst the name's new, this suite, as Darren alluded to, has been around in various formats for over 30 years, and we've invested millions in upgrading this suite. 3 core applications in the suite, which get brought together into integrated database, and you can see on the slide the 4 elements. I think the best way to explain this is on the next slide, is how does this software actually work in action? So on this slide here, we've got a picture of the Combat Surface Combatant, which is a Canadian naval vessel that Pennant supports. So you could replace that with the Hunter-class frigate or Type 26 in the UK. You could even change that to an Apache helicopter, trained rolling stock. The point I'm trying to make is any complex asset that's mission critical in highly regulated sectors is where this software fits. The suite enables our customers to maximize operational efficiency by applying it in different ways. And if I talk you through the tools on that slide from left to right, if we start with Gen S, which is the second product on the slide, this is our configuration management tool. What this tool does is it brings together the information around the asset, the parts, the suppliers, the mean time of failure, the availability, into a super database, which allows the user to make decisions around their supportability options. Moving to the right, we then move to the modeling analysis tool called Analyzer. This is the key tool around optimization. This looks at the trade-off between availability and cost. If I've got £100 million to spend, what availability can I achieve? If you put into the context of the global picture at the moment with uncertainty, how do I ensure that when I'm needed, my airplane can take off? How can I ensure that if we need to defend ourselves, we have the systems and tools at our disposal to protect and defend this nation? This is critical decisions that are going through and never been more topical. And as I mentioned at the start, everything we do is around ensuring these systems are available when they're needed, and that they work. The final tool on the right there is R4I, which is an authoring and publication tool set, which is effectively producing your manuals to enable the user guides, maintenance guides, parts catalogues, and it's all the regulated documentation that you have to have for these assets. Now, all 3 of those tools exist and have existed for 20 years. What we've done is invest in the tools to bring them up to a modern interface, modern coding, modern agnostic backend, but bring them together into an integrated database. Why is that important? Well, at the moment, if you look at the competitive landscape, to achieve this end-to-end capability, most of our competitors will have to integrate between 5 and 8 different solutions. From one provider, you can achieve all this capability. What that means is a couple of things. One, you enter the data once, you enter the data at the front end, and it propagates throughout the whole system. So if you use an example of a vehicle, if a gearbox changes, what does that do to the sparing? What does that do to configuration? What does that do to the maintenance plan? What does that do to documentation? It's a very efficient way of updating and managing data. And then secondly, because it's all one system, data integrity is maintained. You're not taking data in and out of different systems. We're seeing great traction. This is exactly what the market wants, and we're the first organisation to bring a capability of this sort to the market. And I'm very excited about how this is going to scale going forward. I'm now going to hand over to Darren, who's going to walk you through the 2024 results in a bit more detail.
Okay, thanks, Phil. So first of all, I'll walk through some of the highlights, and then we'll go a little bit more focused in certain areas of our financial statements for the year 2024. On the right-hand side of this slide, you'll see our statutory results: 13.8 million of revenue, 1.0 million of a loss before interest, taxation, and amortization, and a 3 million loss before tax. Those statutory results, though, have been heavily impacted by the restructuring exercise and other certain one-off items that I'll walk you through a little later in the presentation. So on the left-hand side of this slide, management has presented a set of adjusted results that are, we're pleased to say, in line with market expectations. We present those adjusted measures, of course, to give fair comparison to prior years and to give a better read into the future operating performance, trading performance, I should say, of the company. I'll point you towards net assets. Before I go into more detail on the trading results in future slides, I'll point you towards a net asset balance that's reduced from 9.8 million at the end of the prior year to 8.3 million in 2024. Again, the result of the large restructuring exercise that we went through in the training systems division that resulted in the impairment of certain intangible and tangible assets within that part of our legacy business. Net debt at the end of 2024 finished at 2.3 million, a slight reduction on prior year 1.9 million. Again, I'll point you towards some of the key metrics coming out of the restructuring exercise, but the restructuring exercise itself had a lower cash cost than was perhaps anticipated at 0.5 million. And I'll give you some more details around that cash flow later. I'm pleased to say, well, Phil and I are pleased to say that there was a positive operating cash flow returned in the period, despite that statutory operating loss. Post-period end, just to touch on the last highlight before we go into more detail in certain areas of the financial statements. Post-period end, the group has taken some really important measures to strengthen the balance sheet and ensure that the ongoing operations are appropriately funded. That includes the completion of the sale of 4 of the 6 properties that we flagged as part of the restructuring exercise in the UK in the second half of last year. The remaining 2 elements of that property disposal exercise we expect to complete in the second quarter of 2025, as well as the renewal of our funding position with HSBC for a further 12 months. Thanks, Tom. I think the next slide is the statutory income statement, which is a formality in there as a reference point. So I think I'll move on to the next slide, please, Tom, which is where, as suggested earlier, I give that reconciliation between the statutory and the adjusted results. Honing in here on EBITDA, which has been our KPI of choice for the last few years. And we bridge from a EBITDA or loss before interest, taxation, and amortization of 1.0 million to an adjusted EBITDA of 1.2, as I say, largely through that restructuring expense of 2.1 million, which is blown out in a little bit more detail on the bottom right of this slide. As I said, that 2.1 million paper cost of the restructuring exercise compares to a 0.5 million cash cost of the exercise, which largely came about from the termination costs for staff members. As well as the restructuring expense, we had 2 or 3 further adjusting items in the period. One being the aborted transaction costs of 0.2 million in the first half of the year, which was detailed in our interim financial statements. Secondly, the customary share-based payment expense add back of 0.1 million, and a profit on the sale of land and buildings in the first half of last year, which was unrelated to the restructuring exercise in the UK. Thanks, Tom. So a little bit more about the training systems restructure. We talked about this at the end of last year in Q4, but actually this is a visual Phil and I thought was helpful to understand the rationale behind why we took the action that we took. As we said, the training systems business has been operating for a number of years and successfully operating, but but characterized by us delivering bespoke OEM projects, highly engineered, and performed by an in-house team largely in Cheltenham, so in-house production with all of the skills on the Pennant payroll. And it's fair to say we were going to market with quite a wide product portfolio. Post-restructure, we're pleased to announce that we now go to market focused on servicing that large installed base of training systems, hardware and software, I should say. And critically, with the decision to outsource the production to trusted and accredited partners that we've been working with for a few years now, based in the UK. What's also important to state is that we've retained core skills within this part of the business, and we're able to scale by utilising the outsourced partner as we take on new work in the future. An ongoing part of the restructuring will be the continued efforts to focus the product portfolio and rationalise it, and that's a journey that will be ongoing. The impacts of the restructuring exercise are listed on the right-hand side and are largely kind of logical, but I'll point you towards the bottom of the slide there, where again I'll reiterate the cash cost of the restructuring exercise of 0.5 million, the headcount reduction from 140 to 110 as we move into Q1 2025. A painful and difficult process for the business to go through, no doubt, but one that will set us up for growth and success in the future. The estimated annual cost savings of the exercise of 2.0 million include 1.8 million from staff cost reductions. Importantly, the property sales and the pay down of debt as a result will serve to significantly improve our current ratio from its historic levels to 2025 levels, which we expect to be north of 90% or perhaps even north of 100%. And that's really going to help us commercially as we go to market as an SME. Thanks, Tom. Next slide. Again, this is a visual of part of the why we had to take the decision to restructure. It was a strategic decision, but it's fair to say it was accelerated by the chronology of how last year unfolded. Phil and the team went into 2024 with ambitions of winning work in the UK with regards to our training systems segment. But as the year unfolded, the defence spending review gave a hiatus in work for our training systems segment. We were left with a burden, if you like, of unrecovered overheads in that division. And this visual, this margin bridge of EBITDA margin from 2023 to 2024 puts that into stark reality. The actions we've taken will serve to alleviate us from that burden as we move into 2025. And the positive there is the software and services margin improvement that was, I guess, masked by that training segment unrecovered overheads number. So, we expect more of that to come through in 25 and beyond. I'd pull out the bullet points on the bottom right of the slide there as to why the management team are bullish on future margins. Not least the cost reduction exercise that we've gone through, which has a direct impact on the P&L. The fact that we are moving towards bidding, being more judicious in the future on bidding on service related contracts in our training systems capabilities. The fact that their aftermarket means lower material content and means higher margins. And last but not least, as we move towards a higher proportion of our sales being driven by our software and services segment, that will naturally have an accretive impact on our margins. Thanks, Tom. Statement of financial position, we've touched on the reduction in net assets as a result of the restructuring exercise. Working capital balances are kind of hidden within these summary numbers here, but our net working capital balance has remained flat year over year. It does include an inventory impairment, which we detail in the financial statements. But if we move on to the next slide, Tom, again, I'm going to reiterate one very pleasing performance measure that Phil and I would like to promote here, which is the fact that despite it being a very difficult year, despite us going through restructuring, and despite that hiatus in work coming from the MOD, we've come out of the year with net cash from operations, which has taken a lot of discipline in driving working capital and continuing to ensure, as Pennant has always done, that we get paid on contracts, whether they're short-term or long-term, in advance of us having to pay out for the discharge of that work. So the balance of the books is in an optimal position. Okay, I think I've touched on the post-balance sheet events, which are detailed on the bottom right of that slide. Okay, segmental revenue performance. So revenue did reduce in the year, 15.5 million to 13.8. But as I say, that was in line with our expectations as well as market expectations as we move through the gears of last year. The reduction is largely coming from the training systems business and is a result of us completing on a very successful 3-year program to put 6 Apache trainers out to Boeing UK. That program was 9.2 million in contract value over 3 years, and our margins were accretive to the gross margins that you see presented in these results today. So a very successful program, but it's true to say that we recognise on a percentage of completion basis more revenue in 23 than we did in 24, and that was the key driver behind the trend in revenue in the year. That will, of course, flow through to 25 as we carry the cessation of that contract through into the start of the year, and we do expect, and we have flagged, that our revenue will reduce in 2025. We expect to be returning to profitability despite the revenue reduction. Okay, thanks, Tom. When I say returning to profitability, just to flag, I mean at the PBT level. A point of reference here, finance costs and tax. Again, largely for reference, but again, I will kind of pull out a salient point there that we're getting great support from the UK government and the Australian government in continued R&D tax credits in relation largely to the expenditure that we're putting into our global software suite. And then secondly, I'll point towards the fact that we carry forward a tax shield in the UK from brought forward losses to the tune of 7.0 million. I think that's an important point to pull out. Okay, and last but not least, Tom, thank you. Just to point towards, again, the difficult decisions that we've made to reduce the headcount, the global headcount, as a result of the training systems restructuring. But I think it's an important point to pull out here on the right-hand side that the average cost per head over the year has actually increased, which speaks to the fact that we've retained some highly skilled team members despite the restructuring exercise. Okay, back to you, Phil.
Thanks, Darren. So looking forward, what does the future look like for Pennant and where are we going? So this slide here sets out some of our strategic priorities. If I start on the right-hand side here with the training systems business, I think Darren's taken us through in great detail how we've repositioned the business, how we've moved towards a aftermarket maintenance, repair, overhaul, upgrade business. And we're still expecting this part of the group to be a significant contribution to going forward. We've recently announced a RNS update on our GenFly program with the UK MOD's intention to negotiate being confirmed, and we're working towards completing negotiations on that contract in the second half this year. That is exactly in line with the types of contracts we want to win, in that it's an existing training system that is going to be upgraded. So it's predominantly software, not material heavy, and it's using our technical skills to really add value to that training system. And it aligns perfectly with the strategy we've adopted. I would also point out, and whilst the defence review hasn't been published yet, there's a lot of speculation that the strategic defence review in the UK is going to focus on capability enhancements and upgrades to platforms such as the Wildcat helicopter or the Ajax armoured vehicle. I'm pleased to say that Pennant has been the training provider of most of these platforms in the UK. Therefore, our repositioned business will align neatly with the UK's intent to upgrade and enhance capability. So the training system business is in a good place. We've repositioned, we've significantly reduced the costs, and it's well placed. But the real growth and the real focus of this group is around the system support software and technical services. So I mentioned at the start, and I'm going to reiterate here, the Pennant business traditionally has operated on a direct-to-market sales cycle. So we typically have individuals in the field selling directly into primes, directly into defence organisations. As we look to scale this business, as we look to enter new markets, new territories, we've been refining our approach and we're moving towards an indirect model. What does that mean? Well, we've been working hard over the last 6 months to identify partners, resellers in territories, in markets to support us. If I give you an example, we've recently identified and signed a partner in Japan. We've also identified and we're working with a partner in South Korea, and we're very hopeful of signing a partnership with a large organisation in India. These are markets that we cannot afford, based on our scale and size, to put people on the ground, fly around the world. So we're looking to build these partner channels. We're also looking at exploring working with large global integrators, organisations that have software suites deployed into defence organisations, aerospace innovation, where the Auxilium suite is complementary. And we're working on a number of partnerships whereby the Auxilium tool set becomes a module or bolt onto the OEM toolkit. And the focus of this business over the next 6 to 12 months is to drive that partner strategy. In the next slide, when we get there, I'll explain a bit further. The other area of focus for us is around the customer support and the customer experience. As an agile SME, we feel that our customer experience needs to be and should be first class. So in the last 6 months, we've been investing in our customer experience, in our training, in our installation, in our support portal. So that when people buy Auxilium, they get the best user experience and an optimal solution. We want to be first in class. Beyond that, if you look at the medium term in particular, there's opportunities for this group to add capability. If you think about Auxilium as Microsoft Office, and you allude it to PowerPoint, Excel, and Word, Analyzer being Excel, R4I being Word, etc., we've got a core capability that services our customer needs. But is it everything? No, it's not. So there are other standards, there are other specifications that we can consider adding into this capability. That could be through partnerships, that could be through internal development, or potentially that could be through M&A. There's also upstream and downstream opportunities in terms of services. One of the challenges of the toolkit with our customers is enabling the user to bring vast amounts of data into a new system. There's a data risk. We've been working very closely with a UK company who's working with AI to help us with data cleansing and data stripping, so that when we sell the software, we can make the transfer of data seamless and risk-free. And that's progressing well. And there's new territories. There's clearly markets that we don't operate. We're very much focused in the Western world, in terms of North America, Europe. But there's other parts of the world we haven't accessed or even engaged with. So there's opportunities to partner and look. So in the short term, very much the focus is on expanding the partnership model, improving the customer experience. But we are exploring and looking at ways to expand this tool set and look at the roadmap and the ability to move the market going forward and what else our customers might need. If you move to the next slide, Tom, just to bring some colour to the software growth targets. Talked a little about this go-to-market earlier. I was going to reiterate it again. The bar on 2025, the current year, is predominantly going to be direct sales. As we build these partner channels, we're expecting to see these partners give us some a real engine of growth through next year and beyond, as we access bigger customers, new markets, and broaden our capability. The other point to note is, whilst Auxilium brings together 3 applications, most of our customers only use one of the 3 toolkits. Now they're integrated into one license. We have the ability now to upsell, cross-sell the other capabilities into all of our customer lists. This holistic solution is integrated. There's no data validation errors. There's no data corruption issues. It's all in the same system, and adds efficiency. So we see great opportunities to cross-sell this product into our core base. And most interestingly, we've introduced a new pricing model at the back end of 2024, both subscription pricing and perpetual pricing. As we move forward, we expect to see a mix between perpetual and subscription pricing, but I'm pleased to say that in Q1 this year, our license sales have been on track, and all license sales have been subscription year to date. So interesting to see how that trend goes, but this is going to be the real engine of growth for the business. So bringing it all together, before we open up for questions, I just want to take a second to try and pull all this together for everyone. So Darren mentioned it earlier. As per our market expectations, the aspiration for this group this year is to return to a positive PBT. We also are really focused on seeing a conversion of our operating profit to operating cash. The operation cash conversion will then pay for the development in the software and allow us to continue to improve our suite. We need to drive the go-to-market strategy, and we need to prove that this model is working. But the aspiration is to grow this business significantly over the next 3 to 5 years. And as a board and a management team, we have a clear plan, a clear strategy, and we aspire to take this business well beyond where it is today. Darren, is there anything else you want to add?
No, that's perfect. Thanks, Phil.
Great, super. Thank you, Phil. Thank you, Darren. Now, if we could turn to the questions. And we have a number of questions that were submitted ahead of the presentation, but please do continue to submit your questions via the Q&A tab. A number of them overlap on certain topic areas, so we'll bring a couple together in a number of these instances, if that's okay. Maybe, Phil, if we could actually start by looking at Auxilium and just understand a little bit about the competitive landscape. First of all, who are Auxilium's competitors? What makes it the option of choice? And what are the practical implications for users?
Fine. So in terms of Auxilium, I talked about the 3 applications. We have competitors for each of the 3 applications. So for the Gen S configuration tool, the key competitor in that space, probably the number one for us, would be Raytheon with its product Eagle. There's a number of other competitors, Heiko in Germany, but ISS Corp in the US, but Raytheon Eagle is probably the main competitor we see in that space. In the Analyzer toolkit, which is the modeling toolkit, the key competitor in that space would be a company called Systicom with their Opus toolkit, and they are probably the main the organisation globally that has the capability on the modeling side akin to PENNANT, albeit they don't have the other toolkits. And the other competitor on the modeling side would be Excel. So probably 60% of our market still use Excel for modeling and then bring it back into the system. On the publication side, again, Raytheon would be a competitor on the publication side, but the publication side is probably the most competitive market. There's competitors in country, globally, there's lots of competitors, but Raytheon again. The point I was going to make, the key point, is that nobody has all this capability in one place. Even Raytheon that have 2 of the applications don't talk to each other. They're separate databases, they're separate products. So to take your data from your engineering into your publications, you're taking that in one system and putting it in another. Why would you use Auxilium? Well, that data will automatically populate your publications. 30 to 50% of your publication will be written for you just straight from the engineering data. And any changes to engineering data will automatically flow through to your end product. That generates huge efficiencies on these complex documentation and these products, and it shouldn't be lost the fact that the data integrity is protected because you're not taking information out of one system to another. So for competitors to achieve the same capability that PENNANT's got, they would have to bring together probably 5 different applications, and we can do it in one. From an IT department point of view, it's a dream. They've got one supplier, one database, one license. They don't have to worry about managing multiple suppliers. So we think there's a number of reasons why Auxilium is in a strong position. I hope I've captured it. Is there anything you want to add, Darren?
Okay, super. And Rob asks, with Auxilium, you mentioned potential opportunities in the rail sector with train assets.
Yeah.
How well developed is this pipeline?
From a rail perspective, they were immature. We have one rail customer in particular that has been trialing the configuration toolset for use on rolling stock, a European customer. At the moment, our focus is on our client base in defence, with the way defence budgets are increasing, with a focus on availability of assets and the threats in the world. We feel that defence with a finite team is actually the focus of the business. But make no mistake, Auxilium is agnostic to sector. We have shipping customers, we have rail publication customers, we have commercial aviation customers, we have space customers. After defence, and 80% of our business is defence, and that's a priority, there are many other sectors with complex assets and supportability needs that we can move our attention to. But at the moment, the priority is to focus on defence.
Super. All right. Now looking at the go-to-market and distribution, could you talk more about your revised sales and distribution strategy using more external parties and agents? How is that progressing? What benefits will this bring?
Yeah. So, great question. I think I touched on some of that during the presentation, but I'll just try and go over it in a bit more detail. So, mentioned that PENNANT traditionally has been a direct-to-market business. That will continue in our core territories. So, in those regions such as Canada, the UK, and Australia, where we have a footprint and offices and people, we will continue to sell direct. But what we've been trying to do is to identify partners who can actually represent us in markets and territories where it may be more difficult for us to access. A good example would be Japan. Language barriers, distance, time zone. We've managed to identify a partner there who can actually represent us in that region and represent Auxilium. But the types of partners we look for vary by region. What we ideally want is partners. We don't want individuals. We want organisations that can bring more to the product and follow our values and follow our intention of customer excellence and unique experience. We want them to be able to train the organisation. We want them to be able to install the product. We want them to be able to provide services into their customers. And that's required. So we're working on partners in each region, in particularly Asia Pacific and Europe. Beyond that, I've mentioned that we're looking at global partners, and we continue to sell direct. So it's a bit of a combination at the moment, but it's an evolving strategy. It's been going for 6 months. I'm pleased to say we've signed up 2 key partners in Asia Pacific, and we're working on quite a number of others.
Great, okay. And aligned to that, one question that's come in, where does Pennant currently have software customers around the world?
Literally around the world. So we have customers in North America, in the US and Canada. We have customers all across Europe, Czech Republic, Germany, Holland, UK, France, Germany. We have customers across Asia Pacific into India, Australia, New Zealand. So the only area we probably don't have any customers is South America and Africa. Other than that, we've got customers across the whole globe.
Okay, super, thank you. A couple of questions actually on this topic, as you'd be unsurprised to hear. Do you expect tariff uncertainties to impact the business?
Yeah, you take one.
Thanks, Bill. Yeah, very simply, no. We don't. We sell into the US through our US subsidiary. And I think that largely protects us from the bulk of any negative impacts that might come about from the current trade wars that are arising from the tariffs out of the US. It's an evolving thing, but no, very simply put, we don't expect a direct negative impact. There may be indirect benefits coming out of the geopolitical environment at the moment, but I think it'd be wrong of us to speculate at the moment.
Okay. And on a similar theme, Rod asks, with the strategic defence review, how do you see this playing out for Pennant? What are the themes that might apply?
It's a great question. Hopefully I touched on some of this during the presentation, but I think for me, the key takeaway for the defence review is whilst UK defence budget's increasing, and whilst overseas defence budget increasing, is the focus of money, particularly in the UK, is on capability enhancements, extending life of existing assets rather than purchasing new assets, which aligns on the training side very neatly to our reposition business, because we're talking about upgrading and enhancing existing training systems. And because of a successful pass on that training side, most of those systems supporting those assets were produced by Pennant. So on the training side, I see that we've aligned the business very neatly with the UK defence review. In terms of the software side, I'm well aware that there's a real focus on how does Western Europe prepare itself for escalation? How do they ensure that they don't run out of munitions? How do they ensure that the plane can take off and do 20 sorties a day? And actually the tool set we've got plays directly into that market. And we're seeing a lot of traction in Western Europe, in particular Germany, Poland, Czech Republic, in terms of actually waking up to the fact that they don't have these systems in place. So I think the whole geopolitical position, the whole uncertainty in the world is driving people to take a look at again and how they look after their assets and how they would deploy.
Super, thank you. Can we take M&A as a topic area and talk around it a little bit? We've had a number of questions, and I will actually just read those out, and you'll see how we've got a couple of sort of various trains of thought here. So Ben asks, are you looking at bolt-on acquisitions, and what criteria do you have for these? Daniel has many questions around this, and I'll just read a few of them out. But he says, Rockwood has mentioned a potential equity raise to support the buy and build strategy. How likely is this raise to materialise this year? Would you not prefer to finance future acquisitions with internally generated cash? Separately, what kind of acquisitions are you exploring? Are you seeking to integrate these acquired software to extract synergies post-acquisition? Will it likely be a programmatic M&A strategy with yearly acquisitions? So there's lots in that.
Yeah.
And can I try and summarise that?
Yeah.
Just three questions. I think it's, are you looking now? Is it a focus now? I think it's, when it does become a focus,
Yeah.
what kind of assets are you looking at?
Yeah.
3, how are you going to finance it?
Yeah, exactly.
And I think the first of those questions is, at the moment, we're fully focused on our strategic deployment plan. That means that restructuring the training system is largely complete. It means launching Auxilium 3.0 in March and then 4.0 in September later in the year. It means, as Phil says, investing in the customer experience, which is absolutely critical for us, and executing on that go-to-market strategy. Returning the business, of course, to the PBT and net cash position in H2 that Phil alluded to. So that would be, I think, the answer, Tom, to the first element of the three questions.
I completely agree with that, Darren. I think the focus still, we've come a long way, we've achieved a lot, but we're still, we've rationalised the property, they've not completed. We've strengthened the balance sheet, the cash is not fully in yet. So we've still got some hard yards to go to get the business into position to move forward on that front. Do you want to take the other 2 bits?
I don't know if it might be the second element in terms of what the profile of a target might look like in the future.
Yes, it's speculation, but I mean, if I point you to the penultimate slide, or a couple of slides before the end, which was the strategic priorities, I think the bottom part of that slide on the left would give you an idea of the characteristics of a hypothetical acquisition in the future. There's clearly gaps in our capability. I've talked about we have a core capability that addresses the global standards. There are other standards and specifications that we don't meet, which we could add. Would we add that through acquisition? Maybe. Would we add it through partnership? Possibly. Would we develop in-house? It's an option. Or could we just ignore it? I mean, they're all options. There's also, I think, I mentioned the partner company we're working with. There's also upstream and downstream service capabilities that we can bring into this tool set, whether it's actually in using the tool set, additional services, whether it's actually getting the data into the system in the first place. And I think that could, again, be a partnership. That could be an acquisition. At this stage, our thinking is probably quite immature, but actually is very clear on that software side, the service side, where you might look to add capability. And it'll be driven by the customer need and the customer requirements. And at the moment, we've got a market-leading tool set that addresses the requirements that are there. So as the roadmap evolves, as the strategy develops, I think it's an area we'll continue to look at.
I think on the funding question, I mean, that's very situational. What we can say is that last year showed that we've got great support from our investor base in terms of the raising of money to continue the investment program in Auxilium. So good support from investors, great support from the bank as well. So I think it'll be situational as we kind of assess the economics as and when that time arises. I saw another question in there, Tom. Sorry, just to jump in, that's kind of related in terms of kind of what would the optimal net debt position be.
Yep.
But I think we kind of addressed that in the presentation by saying that we're expecting through the sale of the properties and the strong operating cash flow in 2025 to return to a net cash position for this business for the first time since 2018. And that means, as Phil alluded to earlier, that we can self-fund the ongoing investment in optimizing our software suite, and we can self-fund that investment in making the customer experience as good as we can possibly make it. And I think that's our focus at the moment, not carrying a strategic net debt position for acquisition purposes.
Yeah, great. That adds some good colour. Thank you. And looking at some of the other financials questions, Daniel asked, do you expect gross margins to increase beyond 50% in the medium term as legacy software revenues are increasingly converted to SaaS, which typically has 80 to 90% gross margins?
Yeah, no, Daniel's quite right. As we grow software, as Phil's slide touched on, our software CAGR that we're targeting, and that proportion of revenue coming from software grows, then inevitably, yes, we expect to move northwards on our gross margins. So yeah, Daniel's quite right.
Great, okay. And Ben says, when do you expect the business to be cash flow positive? Is the current defence spending environment in Europe generating an uplift of inquiries and orders?
I think we answered the first one.
Yeah, so both. So cash positive this year in 2025, and Western Europe is a hotbed for us at the moment. Lots of inquiries, lots of opportunities, and actually some good sales in the first quarter into Western Europe. Yeah.
Great, okay. A general question, maybe you can add a bit of colour, but one question, what is the company culture at Pennant?
Yes.
Obviously important.
Very important question.
Great question. So the culture at Pennant is pretty simple. It's based on 5 core values. That's innovation, teamwork, quality, performance, and respect. Where have they come from? These values weren't created by me, weren't created by the board. These came from the employees. So the employees came up with the values that they thought embodied Pennant, And then last year we asked them to reconfirm, and the same values were confirmed. So our values, and those values define the way we act as individuals, the way we act as a team, as a company. And we want to make sure that everyone in this business understands what we represent and is doing what we want and moving in the right direction. So we're all working towards the same goal. I'd say that we've got a very healthy, positive culture and happy culture at Pennant.
Great, super. One more margin question that's just dropped in from Daniel. I don't know if you can add something to this, but do you expect the increasing exposure to indirect software sales to compress your gross margins over time?
No, it won't. Yeah. Simply put, it's not going to affect our cost base. It's a revenue play, So if we are partnering with a specific partner, wherever it might be in the world, and we are looking at volume-related discounts, then we'd expect the volumes to pay for the discount, if that makes sense, Tom, and to sustain our revenue target. So no, we do not expect, and we are not forecasting those partnerships, those tie-ups to be in any way dilutive to margin.
Great, super, thank you. And final question, as we stand, how much stock do management and the board own? Or will you be buying more given the share price levels?
I'll take that question, Tom. So the board in aggregate currently holds 2.44% of the stock. In February this year, you will note that the management team, the executive, bought 170,000 shares in the company, and throughout 2024, I think all the board bought shares at different intervals. So that gives you a feel for what the thoughts are of the board. My personal intention is to continue to build my holding, but I can't speculate on the rest of the board. But I would expect that throughout this year and beyond, the whole management team and board will look to continue to build holding.
Super, great. Okay, very sportive. Thank you, Phil and Darren, for updating investors today, and thank you all attendees for your questions. Very interesting indeed. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on Pennant, please do get in contact via pennant@walbrookpr.com. Thank you again for attending today's presentation, and we look forward to updating you again soon.
Thank you all.
Thank you.